we're here to tell you today, don't invest in multifamily until you hear this. Hello, everybody. It's Jake Senzia, host of the Wheelbarrow Profits Podcast, here with my co-host, the multifamily mentor, the coach, chef, father six, the best-selling author, the G-Daddy, Gino Barbaro. Gino, how's it going?
Mr. Stenziano, all I've got to say is I wish I had this podcast when we bought our first property. That's all I got to say. I wish.
Gino, it's all about the roadmap, and it's about following the three-legged stool. It's about following the wheelbarrow. And look, you're not trying to reinvent the wheel. You have a solid framework in place, and you follow the yellow brick road. What are we talking about today? We are talking about buy right, manage right, and finance right. It is the three pillars of sound multifamily investing. G-Dad, hit me with some buy right.
So, Jake, let's let everyone picture a wheelbarrow. Let's really get the picture of what we're talking about, because we all think in pictures. So there's a wheelbarrow right in front of you. Jake Stenziano sitting on the grass. He loves burning stuff. He's cutting the grass. He's sitting out there one day. He's sweating. And he says to himself, wow, 3 legs. There's 2 back legs. And there's a wheel. I just got something, Gino. He calls me up. And I'm like, what's going on? He goes, well, I'm out there burning stuff, but this wheelbarrow represents what we should have done from the very beginning. Now, let me get into it. The back leg, he's like, that's buy right. When you buy the asset, it's done. It's fixed. The other leg is the finance right portion. When you finance an asset, that's done. That's fixed also. The third leg, or the wheel, is the manage right. Now, why did Jake think of that as the manage right? Because we're vertically integrated. We manage our own properties. It's in constant motion. You're constantly doing manage right. And if you're not managing the property, there's a third-party property manager that you have to hold them accountable to. So always visualize any asset that you're buying in multifamily. This can be even going into single family if you like, or even self-storage. But for multifamily, it really is those 3 legs. If one of those 3 legs wobbles, what happens? Your wheelbarrow tips over. You have to focus on all 3 of them and set parameters. For us in the beginning, we didn't have buy right. We were just looking for deals. We didn't know how to finance a deal and manage right. We had no idea what manage right looked like. It was like door knocking it all, but that's all right. We all have to start somewhere. So when we hit upon that and Jake called me up, I'm like, Jake, this is great. Let's create this framework and let's break it down into the buy leg, the manage leg, and the finance leg. And what does the buy leg look like? For us, our clarity, and this is what everyone has to focus on. What are your parameters? What are you looking for? We're going to talk about the 3 pillars of real estate in a little bit. But right now, when you're setting up your buy right parameters, it's all about what you want. How much capital do you have? Where are you going to be investing? How much time do you have? What are your goals with multifamily? Do you want to do this passively? Do you want to do it part-time? Do you want to transition into it full-time? We didn't have those thoughts when we first started. We just wanted to buy assets. That's all we wanted. And there's nothing wrong with it, but we were a little confused. We didn't lack motivation. We lacked clarity. And I think that's one of the best things about this framework, buy right, manage right, and finance right. It's going to offer you the clarity. Now, I'm going to hold up the first book here. This is the Wheelbarrow Profits book. This is our book that wrote about the 3 steps in here. So I want you all, I'm going to leave a link down below. Go grab it on Amazon. If you buy it and you leave us a review on Kindle, I will send you a hard copy in the mail, gino@jakeandgino.com. So I'm going to be giving away the farm here a little bit. Jake's going to be cutting me off and going, stop giving away the farm. But this is an important podcast for us because this is going to lay the groundwork, the foundation. When you're building a business, when you're building a building, or when you're building a multifamily experience, you're going to be becoming a multifamily entrepreneur. That foundation has to be strong. So let's focus on all 3 of these pillars. Once again, the buy right. What is your criteria to buy right? Let's focus and go really deep, really granular. What cash on cash returns are you looking for? What type of cap rates are you looking for? What debt coverage ratio are you looking for? What type of market? When you're first starting out, I don't want you in 4 or 5 different markets. Focus on 1 or 2 markets. Become a master at those 1 or 2 markets. Start creating those relationships in those markets. That's how you're going to get deals with relationships. Let's get even more granular. What age is the building? Is it a pre-70s? Is it 1980s? Is it brick? Is it pitched roofs? Because I can tell you one thing, if you could say no to something, you're going to get to that yes a lot quicker. If you get really drilled down and you're looking for a certain type of asset, Jake and I, what do we like? We like the mom and pops. That's what we're looking for. We're looking for mom and pops right now. And we're going to drill down in certain, every market has different criteria. If you're investing in Nashville, cap rates are different than investing in Cleveland. That's why focusing on that one specific market is going to really help you out. So that buy right is crucial into focusing on what you do want. And when you're speaking to investors or brokers, you're ready, you're prepared, you're going to sound professional, and you're going to find that deal a lot quicker.
I'm going to give the folks a little meat. A nice salty turkey leg right now because
I'm more favorable to wings, but if you're gonna give me a leg, I'll take a wing. I like dark meat, bro.
We can still get the buffalo sauce on the turkey leg. It's not a bad thing. But so we have Gino's talking buy right, and we basically target two deals. And what did Gino just say a minute ago? You need to have your parameters set. Think of someone sifting for gold, okay? It's the same thing when you're looking for deals. You're sifting for gold. You're underwriting deals. You want to be able to analyze them quick, get rid of the garbage so you can get down to the gold and what you really want, okay? How do we do that? We have two primary deal types. We call them Deal A and Deal B. Deal A is down the fairway. It's going to have what we call agency debt or Fannie Mae or Freddie Mac financing, or maybe even, potentially CMBS. It just doesn't seem to be in the picture right now. Or it could be a HUD deal, like a 35-year fixed. Okay. So we're looking for non-recourse long-term finance in a deal that we're going to be able to place with that type of debt. It's going to be in a good market. Okay. It's going to be of a good vintage, meaning that it's probably sometime in the 1980s or later. It's going to have pitched roofs. It's going to have central heat and air, all the types of things that we know our folks are looking for. And it's going to have cash flow from day one. It may be something that is interest only for 3 to 5 years with really good cash flow where we know we can gradually increase rents. We're long-term buy and hold investors, so we want to see cash flow continue out through the life cycle, and we're going to get cost segregation on it. So we know it's going to be great for our taxes. So that is your relatively clean, stable asset that we're going to be able to buy with cash flow from day one. Then there's deal type B. This is your monster. This is something that we did last year. We like to do only one of these at a time because, as Gino alluded to earlier, we're vertically integrated. We manage the entire process. We manage the turns. We manage the renovations. So these deals, what we like to do, we typically use what we call bridge financing on these deals. You can use a community bank. You can use a traditional bridge lender with non-recourse. Willet RanCap, if you're looking for something like that. They have some really great products. These deals, though, the last one we did, Gino, we cleaned the whole house out. I mean, ultimately, it was 50% occupied when we got it. By the end, there was like 10 folks left. We went through, we basically gutted every unit, redid the parking lot, redid the roofs. Gino was telling me to tear down a gazebo, but we even saved the gazebo. We turned the office into 2 additional units. That's actually going on right now as we speak. New RAN flags everywhere, the beautiful RAN blue flying in the sky. And, new lighting throughout. I mean, we just, from top to bottom, we just renovated this entire complex. Now, those can be very lucrative, but they can also take a lot of bandwidth. They can take a lot of resources from your team. That's why we recommend folks probably not doing that on your first deal, but also doing one of those at a time as you grow. Maybe when you get bigger and you really get into it, you can handle 2 or 3 of these, but they are very intensive to manage, and they do take a lot of your team's bandwidth. So when you're talking buying right, think about what we just said, having parameters. We're so clear. We have 2 deal types that we look at. There's certain times when we look at those deals. There's specific markets that we're looking to do these in. When you have this type of clarity, you can sprint, you can run. You're the slingshot and you're going. When you don't, things are confusing and you lack clarity. Not having clarity slows you down so much in this business. You need to get clear on what you want and then attack with and be aggressive about it, because it's a competitive market. And if you're not clear and you're hemming and hawing, someone else is going to be more aggressive. Because as the G-Dad likes to tell the story, the minute that deal came across his desk, he sent it over to me. I was out there the next day looking at it with the team. We locked it up, and the rest is history. That's how these things go in a hot market.
So to continue with that thought, the reason why we highlight these 2 deals is because of where we are in the market cycle. Let me bring in the 3 pillars of real estate here. The 3 pillars of real estate are proprietary 3 pillars: market cycle, debt, An exit strategy. Let's leave debt and exit strategy alone until after we finish the framework. The market cycle is very important. When we first started, we were buying 8 caps, 10% cash on cash return, anything we could buy. The financing wasn't there, the deals were there. Now, as we're in this part of the market cycle where we are in our markets, it's still emerging, it's still growing. I don't see a recession in our area. So I'm afraid that if the market does take a downturn, we want assets that are going to be, if they're going to be CapEx heavy, we have to buy them at the right price. And at this part of the cycle, you're buying C properties at 4.5, 5 caps. You might as well go and buy a B property for a 3.5 or 4 cap with much less work. That's why that deal type A really resonates with us, because we're long-term fixed rate financing. I'm going to let Jake touch on finance right next, but that's why we're looking at it. So you really have to understand the 3-step framework and couple it with the 3 pillars of real estate, and it will make you more successful. What you're trying to do when you're investing, you're trying to limit your downside risk. And we are limiting our downside risk by utilizing the buy right framework and coupling with the finance right framework, and then ultimately managing these properties properly. That's how you're going to limit your downside risk, by putting all 3 of those together, and then conceptually understanding where we are in the market cycle to hit upon it. So always focus on where we are. And that's why your parameters are going to be constantly being changed. They're going to be fluid. In a year from now, we may be talking going, wow, there's deals right now. I can buy C properties for 6.5 to 7 caps because the prices have dropped. Maybe that's the time you change your parameters. Just keep educating yourself and make sure you know where your market is, what part of the cycle, because market cycles, for the real estate can be whole, right? They're macro, but they really come down to micro. They come down to cities. And in most instances, they come down into neighborhoods as well, because you have different market cycles of what's going on from one neighborhood to another neighborhood.
So Gino was alluding to finance right next. And the thing with finance right is, again, these are our parameters. They don't need to be yours. We're just sharing ours to give you a clear example. So you need to select what's important for you, because if you're in New York City, you're probably going to have different, goals and parameters than us being in the Southeast, California, likewise, etc. So financing, this also depends on what your goals are. We are long-term buy and hold investors. So what's the most important thing to us? Ask yourself. For us, it's reducing interest rate risk. What is interest rate risk? Well, we're buying things right now in the low 3s. Okay. The interest rates are 3%, 3.5%, whatever the case may be. So we want to create an asset out of the debt. If we lock that in long term, say we get 15 years with Fannie Mae. Okay. Well, if rates go up in 3 or 4 years, that's an assumable loan. Again,
Yes.
We want to hold these things, but at that point, now we're say rates are at 5.5% and we're at 3.5 locked in for another 11 years. That's sexy to assume something like that, because you're getting that low fixed rate in place. So if it's for us, we're reducing interest rate risk because we're seeing out 15 years and we don't ever, have to worry in the next 15 years about where the rates are going to be. We've paid down debt at that point. Or it becomes an asset that someone can assume. So we want to sleep well at night. So we bought the asset right. Now we're financing it right, meaning that we're taking that interest rate risk off the table. Maybe we got a nice little IO to pad our pockets with some extra cash flow in the beginning. That's what we're looking at when we talk about finance right. That doesn't mean that we don't do bridge financing either. Like if we're talking about deal type B, we're going to look for something with IO, then to roll it out to long-term fixed rate financing. But ultimately, it's locking in those guaranteed payments for the long term on a non-recourse solution. That's what finance right looks like for us.
So for us, when we started out, finance right looked like community banks. When you're first starting out, agency like Jacob referenced, Fannie and Freddie, loans are $1 million plus. Our first property was only 650 grand. We employed 2 strategies. We employed the community bank and we employed seller financing, creative cash.
Oh, I knew that was coming.
Hit me up, baby. Gino at jakeandgino.com. Leave us a review on the book. I will send you a hard copy. Why do I pick this book up, Jake? This is really important. I had mentioned market cycle. The last 3 months, I've heard more about master lease options and seller financing and creative financing techniques than I have in the last 3 or 4 years. Am I right? Is it true?
I just saw master lease option. Who was it?
Vince Gethings, bro.
Vince,
Big shout out to Vince.
I saw you in the community, buddy.
Wrote the book, $15 investment locked up in MLO. All I'm saying is that's where we are in the part of the cycle. If you educate yourself and you want to learn more how to work with Jake and Gino, go to jakeandgino.com/apply. See if we're a good fit. Learn these techniques, learn these strategies. Vince spent $15. He's an amazing coach, and he didn't know what an MLO was, master lease option. Went up, and actually, he's got that building. He's going to use that as his office. So you think he hit a home run with a $15 investment? Creative financing is going to be huge because right now, debt is a circulatory engine of the economy, and we're seeing debt is pulling back right now. All of a sudden, loan to values are dropping. There's still reserves out there. A lot of mom and pops have a lot of equity in these deals, but guess what? They're not financeable because all of a sudden economic occupancy is at 78% when physical is at 94%. And guess what? A bank is not going to loan on that. So you need to pick up a copy of Created Cash and start figuring out how you can start solving problems and start being creative with your financing solutions. Getting back to community banks. I personally love community banks. How about you, Jake?
I love them.
I think they are amazing. We like to use them as bridge. We're this deal that Jake had just mentioned is 48 units. We bought it all cash. 30 days later, we went out and refinanced all our money. We pulled an 80% loan to cost. We financed 80% of the renovation with the deal. Now, in the next 2 to 3 months, we're going to go back to the community bank and refi again. We're going to pull out all the money we had initially, and we're going to refi probably another 20 to 30% in addition to what we put into the deal. So we're going to have extra money out of the deal. We're going to hold that deal for another 6 to 12 months and then go to Fannie and refi a third time. So you see how we're using community banks. We're using them as bridge. They're amazing. They're easy to work with. And when you first start out, you know what? There's recourse component to it. But guess what? Buckle up, Buttercup, because you got to take a little risk in life. Am I right? That's what everyone says. Oh, recourse
Amen,
debt.
brother.
We had nothing to lose in the beginning, Jake and Gino. We had to take the risk. I mean, you can make all these excuses and be nilly-willy. If you're buying right and you're financing it right, it's time to take the risk. We took the risk, and guess what? Over $11 million of refinance proceeds 6 or 7 years later. I think we did the right thing. If Jake and Gino can do it, you can do it out there. Trust me. But make those relationships with community bankers because they're out there. They're hungry to make loans. Look, I want you all to Google fractionalized banking. See how banks make money. They're going to want to give you money. They're going to want to lend money to you because they're making a ton of money on the money they lend to you. So they are one of your biggest partners. If you can get that mind shift to say, wow, banks are one of our biggest partners. They're lending up to 85% of the value of the property. That's freaking huge. I mean, what other asset class can you do that with? Try to do that with stocks. They'll put you in jail. I mean, that's what's amazing about real estate. It's a leverageable asset. Learn how to finance these assets properly. And like Jake said, the new paradigm is debt looks like it can become an asset, especially going long-term. It's free money. I just bought a house down in St. Augustine at 3% for 30 years. Cost seg that baby. Guess what? Home run. I want you all to start thinking in those terms.
Yeah, it's really interesting too because like you have a team, we call it a team member pyramid at Jake and Gino, and you really do need that solid foundation with the bank because you're going to be putting all your deposits in there. And then look, when things have to get done, we have such a good relationship. We text the people over at the bank. They just handle stuff for us. And you get such better customer service at a community bank. And look, I'm dealing with these folks every week with something. They need this sign, they need that. And more assets, more entities that you do, you want to have that solid foundation relationship to be able to get this stuff done quickly.
And I'm going to throw out another golden nugget to all of you investors out there who are listening to the show. I know everyone who listens to the Jake and Gino show, you're all high level. What Jake and I have been employing for the last few months is a concept called infinite banking, the infinite banking concept. If you want more information, email me, gino@jakeandgino.com. What you're basically doing is you're creating two assets. Basically, this is the way to finance your properties. You're putting money into a whole life policy, then you're borrowing out that money. It's uninterrupted growth. You're basically borrowing your money back. You're creating one asset with the whole life, borrowing the money out and putting it into your deal. And the cash flow in your deal is paying back the loan. So when that loan is paid off, guess what? You have the whole life policy and you have your asset. What's more beautiful than that? I mean, I'm getting whole life policies on my children.
I want to tell you what's more beautiful than that is that in addition to that, you're protecting your family. And then if you're like us and you look long-term and you look for legacy wealth, when the estate tax comes and, you know, unfortunately we all pass someday, you're actually going to be able to cover those taxes with that policy. So it just checks so many boxes. And I think it's such an amazing wealth builder.
It's part of the finance right portion. Yeah. You may not be ready when you first start out, but keep an open mind to it. The people who control the flow of money, the investors who control where their money goes, the investors who control as them being the bankers are the ones who are going to be successful. It's all about shifting your mindset. Remember, people see life as they are, not as it is. Some of you may be thinking I'm crazy saying I'm going to put money in a policy that I'm going to have to pay and borrow money out of that policy, my money. Don't think of it that way. You
No,
have an asset here.
The assets paying for the policy. That's the
That's
difference.
right. And
Yes.
it's just an amazing concept. Like I said, hit me up if you want more information. We could spend another hour speaking about this, but that's part of the Finance Right portion. And that's, I think, the little golden nugget with Finance Right. Go to community bankers, start correcting those relationships. And Will at Rand Cap is another amazing resource that you can have. Now, I know Jake's favorite part is the manage right. Our first asset, we started managing. We wanted to learn how to manage these assets. So Jake started out, and it was a fantastic way for him to leave the business, to leave his W-2 job and go into the business full time. He was boots on the ground. He loved it. And 1,500 units later, we've got an amazing property management company, headed by Jen O. We got Shannon, we got Chelsea, we got rock stars on the team. And it's really fulfilling because what we're doing is we're creating an amazing experience. At least we're trying to create an amazing experience for every one of our residents. They're not tenants, they're residents, and they're not units, they're apartment homes. This is where people live. There's another mind shift. If you look at the Chick-fil-A, Jake wants to become the Chick-fil-A of property management because there are nobody out there. And that's what we call our Blue Ocean strategy. We want to deliver that customer service, that C-space. Is it easy? Heck no, it's a really hard endeavor, but we're out there striving every day to get better. And the better customer service you provide, the longer your tenants are going to stay. And that's the number one complaint that you have in the C and B space. Residents, they don't leave because you raise the rent. They leave because your customer service sucks, because you don't know anything about them and you didn't take care of them. So the manage right portion can save you a ton of money, and it can also make you a ton of money.
So very similar to when we were talking about the different deal types, there's different components to manage right. There's your repositioning strategy and how you take deals down. We were just talking about it with the big turnaround plays, but then there's also how you manage consistently and have KPIs and systems in place to see things through. And you don't have to be the manager,
No.
but one of the things is if you are an asset manager or if you hire a third party, you need to be managing these folks. And I know I sound like a broken record. I say this all the time. You need to be on a weekly call with your property manager. We call it a weekly level 10 meeting. You need to be doing that, and you need to have a structure where the priorities are at the top. A priority is something that takes more than 8 hours during the quarter. Below that, you're going to have your tasks. The tasks are going to be followed up weekly. Did we get the signage up? Did we get the new mailboxes in? Did we get the parking lot restriped? Did we get the new roofs on? Did we do the tenant event? Yada, yada, yada. This is a busy business. This is a business. And this is the business. And that's where people go wrong. And that's why we buy from mom and pops, because they buy this. Oh, I should be in apartments. They're great. Or I should be in industrial. That's great. No, this is the business that you should be in, because it can change your life forever. You're able to go out there, and you're also able to change to the folks' lives that you're basically serving as well. That's that Blue Ocean strategy. But when you're on those weekly L10s, that's that cadence of accountability. And they know that the folks that are managed know that you're checking in and know that you're holding them accountable. You need that cadence of accountability, and that's what really changes it. In addition, on Fridays, company-wide, we send out something called the Pulse. It shows delinquency. It shows vacant unrented. It shows occupancy rates. It shows cash received the prior month. It shows expenses for the prior month. And it also shows the accounting income versus expense, because cash is different, okay? Managing cash is different than managing the accounting, and everybody sees it. We talk about the Rockefeller habits. That is something that Gino and I were coached heavily on. That's systems training, okay? That's business operations. And throughout that, you follow the Rockefeller habits. The whole team needs to be aware of what they're held accountable for, what those systems look like. And that's what it takes to manage right. It is, and I know this is crazy, but it is a business, and it needs to be treated as the business, not an investment. And that's the difference. The folks that treat it as the business, as their core priority, are the folks that do really well managing their assets, because that's the only thing you can change. Once you bought it right, it's fixed. Once you financed it, it's fixed. What do you have left to do? Drive revenue through superior operations.
I want everyone to take out a pen and paper, and I want you to write this. If you have a vision board, write on your vision board: I am a multifamily entrepreneur.
Woo! Say it again, brother.
Right? I am a multifamily entrepreneur. Change that. I'm changing mindsets this whole show, because it really is. I wish I had been thinking about this on my first and second deal. All I wanted to do was landlord and make $100 per door. That's what I was shooting for. That's what a lot of people are shooting for. You're missing the train, my friends. There's so much more to it. It's a scalable business. We have economies of scale. You can hire people. You have amazing tax benefits. Your residents are paying your principal down. There are so many benefits. Become the asset manager. Let's distinguish between asset management and property management. Manage right has two layers. We can't get into it on this show, but Jake and I, when we first started, we didn't even know that. We property manage and asset manage all at once. Well, hold yourself accountable. Property manager. If you have third-party property management, you are the asset manager on top, driving the ship to property manage. And if you're doing both, those are two different responsibilities, because when you're asset managing, it's part of the bottom line. Property managing is making sure you're running a tight ship with budgets, and you're actually looking at and you're trying to rent properties, make sure you're not overspending, really delivering a superior customer experience. So know the difference between the two, but always think of yourself as an entrepreneur in this business. And as you start scaling, you're not just going to do deals for fees. You're not just going to do deals to get paid. You're going to do great deals that pay you and give you less of an ROE. Return on effort. You're going to want to do less effort with these deals and do better deals, do better quality deals as you start scaling up.
That's the trajectory. I think in a lot of us, you got to get started. You got to get into the game, and then you can refine your systems. And day in and day out, we work to create a well-oiled machine. That's what it's all about, because you create a well-oiled machine. That machine takes care of you, your family, your residents, everybody that's on team members, regardless. It's extremely important.
Let's take a quick time out, and we will talk about the 3 pillars of real estate on the other side.
All right, we're back. G-Daddy, hit them with the 3 pillars.
So the 3 pillars we had mentioned, everyone write this down. Market cycle, number 1. Debt, number 2. And exit strategy, number 3. Now, we touched a little bit on market cycles already. I really need to go to the exit strategy, because I think this is where Jake and I sort of fumbled in the beginning. We're buy and holders forever, and there's nothing wrong with that. But that's the only way that I thought you should buy real estate. Some people who syndicate deals want to go through a 3 to 5 year process. After 5 years, they want to flip out. Great strategy. It depends where you are. What I wanted cash flow from day one to be able to build my cash flow up so I could leave my job, right? I want you all to picture a conveyor belt out there. That conveyor belt is going. Your job is to stack assets on that conveyor belt. It may take you a year. It took Jake and myself 18 months. Like I said, if we could do it, anybody can do it. 18 months to get on that first conveyor belt. But guess what? 3 months later, we got another deal. So within 18 months, we've got 2 deals on there, right? They're going. And then at the end of year 2, guess what? We have a 3rd deal. Within 3 years, we have 3 deals, and they're starting to matriculate. They're starting to have those liquidity events. The first 2 deals we refinance, and then the 3rd deal gets refinanced by year 3. And guess what? There's a ton of money to continue that along. What is your exit strategy? Is your exit strategy to buy these things, hold them long-term? Is it to buy them, to refinance them, to get that money and repurpose it into another asset? Or is it to buy the asset small, flip it, and get into a bigger deal? We've done all of them. I love buying small apartments. If you're in the flipping business and you're flipping single family homes, you need to hear this. Stop doing that. Find the 5-unit, 7-unit, 10-unit, flip that one. You know why? Same amount of work, a lot less expensive to turn an apartment unit than it is a home. You can cash flow while you're trying to flip that apartment unit. And guess what? When it's all stabilized, you may say to yourself, wow, I've got a 10-unit here. It's printing $1,000, $1,500 a month in cash flow. I refied all my money out. Maybe I'll keep it. Flipping an apartment is a great way to create wealth or to create that next deal. We flipped a couple of small ones. We flipped up to date 4 small multifamilies. Every time we've gotten that cash, we repurpose it and put it into a bigger deal. So always think about your exit strategy when you're getting into a deal. Very important.
I still don't want to sell. You're not going to convince me of it. No, but here's the thing, guys. This is what is so beautiful about, Gino and I are both real estate professionals, and, speak to your CPA if you're not, aware of what that means. But we buy the deal. We get the deal to cash flow. At the same time, we're implementing something called cost segregation. Hit up the G-Daddy, Gino at jakeandgino.com. If you don't know what cost segregation is, he can help you out with that. Buy the deal, cash flow the deal, cost seg the deal at the same time. What we like to do at that point, refire cash out. Guess what? Take the cash, put it into the next deal, rinse and repeat. Buy the deal, cash flow the deal, cost seg the deal, refi the deal, do it again. And what happens is, because you're using that cost segregation, it's reducing your federal taxes tremendously. So that's another asset. That's another vertical within the strategy that you're basically taking advantage of. And you just keep, doing it over again. Rinse and repeat, rinse and repeat, rinse and repeat. And then, like Buffett says, you build up this snowball, or Gino was talking about a conveyor belt. Whatever it is, it builds up over time and it grows. And it's amazing to see it in action. The thing that everyone lacks, I know not, most of the folks not, listening to this show, but so many of the people out there, they lack that long-term vision. They lack that vision to look out into the future and say, if I commit to this, I can get there. So many people are like, oh, it's a pie in the sky. I'm going to do it for 6 months and see how it goes. No. Dolphin says, you got to keep going. You got to work it until you get that deal, you refi it, and then you keep duplicating the strategy, because ultimately it's just stacking assets and allowing them to cash flow, and that cash flow to build. Cash flow replaces the W-2 income. Things get really interesting, and you keep moving from there.
So Jake had mentioned cost segregation. Go on our YouTube channel and Google Tom Wheelwright on the Jake and Gino YouTube channel. Tom Wheelwright's got an 8-minute video discussing cost segregation. It's so simple that even I can understand it. And it's just like, if you want to send it over to your investors or to your partners, you'll be like, why hasn't anyone else told me about this? It's one of the most, I think, amazing benefits that the government gives us operators, because the government cannot provide affordable housing. So they have to incentivize it. Taxes are written to stimulate behaviors, everybody. That's the bottom line of why taxes are written. And cost segregation is an amazing benefit to apartment owners. So if you're out there flipping single family homes, maybe you should say to yourself, hold on a second, I'm doing all this work. I'm paying top tax rates. What is Jake and Gino doing differently than I am? It's holding for the long term and building a business. Now, the debt component is really tied into the finance right. When you're looking at a deal, the second pillar, you need to know what your exit strategy is so you can couple it with your debt. Because if you're going to flip an apartment building, but you're getting long-term fixed rate financing, guess what? That's going to screw things up, right? You need a little bit more flexibility. So maybe you go to the community bank or you go to the non-recourse bridge financing. So knowing what the exit strategy will allow you to place the perfect debt that you're looking for on your deal.
Yeah, and like Gino alluded to earlier, this is your biggest partner in so many different ways. Because here's the thing: the community banks. You could say, well, what if I refi out of my community bank? Are they going to be mad at me? They're most concerned about your demand deposits. They want to build up those deposits. So every time you get a deal, we like to give it to the same bank.
Yes.
Hey, guess what? I texted my banker. We got 3 deals that we're doing right now. I said, you're going to get 3 new deposit accounts. He's like, do I get the loans? I said, nope. He goes, well, that's okay, because we love the deposits. And I said, on the next one, we'll be talking to you. So, it depends. Sometimes they get it, sometimes they don't. But when you're shoveling all that money in, that allows these smaller banks to grow. So I think looking for a bank that has great customer service, they have a long-term vision, they're looking to grow alongside you, makes the best partner.
I love that. And the last one, the market cycle, really quick, everybody, write these 4 down. The first one is the recession. Recession is the first part of the market cycle. The second one is recovery. The third one is expansion. And the fourth one is hypersupply. Now in a recession was maybe 2009, 2010, 2011. Recession, that's when that part of the market cycle where there's deals out there, but there's no money. The economy's stagnant. There's no rent growth. Jobs are getting lost in the economy. Tough time to buy, but guess what? That's where you get really, really rich. And recession's a tough place to buy because the debt's dried up. But guess what? You got creative cash. You got creative financing techniques in the recession part of the cycle. Know what strategies to utilize. The second one is the recovery. Recovery, I think, probably lasted from 2011 to 2014, 15. The economy's starting to recover. Jobs are coming back. Unemployment's going down. There's a better, consumer sentiment going on. The third one is expansion. We've probably been in expansion, for the last few years. But depending on which market, some markets may be in a recession right now, like Chicago, and some of the markets are in a recession because jobs are gone. The pandemic has destroyed them. But come down here in Florida. The fourth one is the hypersupply. A lot of markets in Florida here are in hypersupply, which means there's a tremendous amount of growth. There's just constant building and building and building. And there's something called the absorption and the delivery. A lot of these products are being delivered. A lot of multifamily products are being delivered, but are they being absorbed? If they're not, that means we're in hypersupply. Right now, there's so many people moving to Florida, thanks to Governor Cuomo and to Governor Newsom, that, the absorption is happening. If things slow down a little bit and you have all this multifamily product coming on, then you may end up hitting hypersupply. So just know where you are in that part of the market cycle, and that will dictate what kind of strategies you're using. Are you syndicating deals? Are you actually buying deals and maybe flipping out? Are you getting long-term fixed rate financing? Are you using seller financing, creative financing techniques? Knowing what part of the market cycle will help you out and understand what kind of strategy or technique you're using in that cycle.
Anyone ever accuse you of being a bottom feeder?
I've been
Because
accused of a
I've been
lot.
accused. People have accused me of being a bottom feeder before, and I take that, as a compliment, and that's okay. But if you're accused of being a bottom feeder and you like value and you like deals, Gino was talking about buying during a recession. What's the most important thing to do now if your local market or the market you're investing in is not in a recession? Get educated. Education times action will equal your results, and you need to get clear on your parameters now. You need to get your
Yes.
debt lined up now, because if you're a bottom feeder, and look, we're buying now, we buy through all cycles, we buy through all phases, because we have parameters that work for any market cycle. But if you're saying, well, I want to get really active, or you're wait, it's too late, you're already going to be behind. You need to get active now. You need to start analyzing deals and putting deals under contract now, because if it gets to the point where there's more deals than you can take down, you better have those parameters teed up, and you better have that debt lined up, or you're going to be left behind. So,
Jake, that's a great point. We should have made that in the very beginning. The question is, when is a good time to get into multifamily? The only good time to get into multifamily is when you're ready for it, because you're going to need a little bit of time to get involved. You're going to have to learn the space.
you're going to have seasoning, right? You need to get seasoned.
Yeah, you're going to have to create relationships. And more importantly, let's say the market crashes and I find a deal. Yeah, $3 million deal. Well, I don't have any money. I don't have any investors. Guess what? That's pretty worthless, right? You're going to scramble around. You need to have substantive relationships. So now is the time to get into it, because guess what? There are going to be continual market cycles. Things are going to be constantly changing. You need to get educated. And once you have that mental representation in your mind of how to do this stuff, it will carry with you forever. And this is the great thing about being an investor. You're never an expert because you're constantly learning. Things are always changing. When we first started out, we didn't even know what a mom and pop was. We didn't know this 3-step framework. We didn't have the 3 pillars of real estate. This was all created from us learning and from us implementing. And the more we continue to do that, the better we're going to get at these strategies, and the more techniques we're going to learn how to utilize and to teach. So you know what? If you're on the sidelines and you're saying, now's not the right time, prices are too high, guess what? It's never be the right time for you, because I could have felt that same way back in 2013. Looking back, GDP was 1%. Rents were $300. The economy sucked. There was no money out there. There were jobs, but you know what? There's a lot of risk because people didn't have jobs, and the residents out there, were they paying rent? Yeah, but the rent was so minimal, and there was a lot of risk in the market. So it's never the right time until you are ready for it.
Hey, bottom line is deals will be done with or without you. Millions will be made with or without you. It just depends if you want to participate or not. That's the thing. That's where we got to get real with it. It's going to happen. Deals are going to get done. Millionaires are going to be made through real estate, and it's up to you. Are you going to get in, or are you going to sit on the sidelines?
So, Jake, I'd like to end with a story of how we met and how the partnership started and how it's grown to where we are. Back in 2009, I'm in the kitchen. I'm sweating my ass off. I'm working on the grill. My brother comes in with a glass of wine, and I'm making port. I think it was port, actually. And I'm making this chicken called Jake's Chicken. I'm sprinkling this cayenne crap on there. This stuff is great. I'm sauteing zucchini behind me, but I'm sweating like crazy. My
cherry
brother walks
peppers.
in.
Don't forget the cherry peppers, baby.
I got mushrooms, zucchini, broccoli, cherry peppers. It is, I'm telling you, the smell, it was just amazing. Sauteing in garlic and oil. It was just nice and light. This guy, Jake, wanted something really healthy for the doctor's offices. In roll Jake and Mark. They're giggling and having a great time. I'm like, dude, you want to come back here and help me? My brother's like, yeah, I'll be back in a few minutes. I'm back there by myself. I meet Jake. I send the food out. Next day, Jake comes by, and we start talking. And Jake wants to get into real estate. And I wanted to get into real estate. And I'm like, dude, let's continue the conversation. As things get, on, Jake had met a doctor named Dr. Nesharat. We both knew him really well. And that's why Jake was really intrigued with real estate from this Dr. Neshi. And it was really he's an amazing doctor, amazing story. He kept his autonomy all throughout that whole Obamacare, where a lot of doctors were selling out to medical groups. And Jake, in the back of his mind, always said, I want real estate. I knew real estate was great because my parents living the dream. They owned the restaurant. They had 3 apartments upstairs. They had a couple of little small multifamilies making cash flow. So, fast forward 2 years, he's sitting in the dining room. It's 2011. I'll never forget it. He's like, dude, I'm moving down to Knoxville. I'm like, Knoxville? Where's Knoxville? And he's like, it's in Tennessee. Great place. Nice weather, emerging market. no state income tax, quality of living, cost of living. I'm like, well, let's look at the deals down there. So we whip out the computer. I'm on LoopNet.
LoopNet, baby. Yeah, no one
Yeah.
uses LoopNet anymore. There's probably deals on LoopNet right now.
And I'm like, Jake, there's some deals here. 30 a door. This looks pretty good. Looks pretty promising. We can cash flow in these deals. So Jake moves down there. And, it took us a long time, 18 months to find that first deal. Jake's in transition. He's living down there by himself. His fiance at the time was still up in New York, Whitney. She moves down a few months later. He's a little lonely. He's got his routine going on. He doesn't have the vibe. He doesn't have the little boy voice and the cupcake thing going on. It takes him a little while to get all that all going. But when he finally does, and we finally start respecting the brokers, we start treating them like the gatekeepers, we found the great broker and we closed on our first deal after 18 months. And then 3 months later, we closed on our second deal.
Then the floodgates open, baby.
And then all of a sudden, it just happened because we were able to attract and we were able to figure out this whole business of mom and pops. And let's get back to it. The buy right, the manage right, and the finance right. And that's what's allowed us to continue to scale and to learn all these strategies and these techniques. And throughout that process, we've been able to create the honeybee and multifaceted multifamily, where we're creating the Rand family of companies, where we have the education company, we have the capital company, we have the syndication company, we have Rand Cares, and we have another brand coming on now. It's all faceted around multifamily, and we've been able to grow these amazing companies from a little 25-unit property. And that's what dawned upon us when we started doing this. We weren't entrepreneurs. We weren't creating businesses. We weren't creating revenues of, streams of revenue. With this mind shift and thinking ourselves as entrepreneurs, that's when the floodgates started opening up.
Gino, you got me so fired up today with the one quote. I am a multifamily entrepreneur. That is power, bro. I love you. Great job today.
My friend, thank you. And everybody out there, stop wasting time. jakeandgino.com/apply. Hit me up, Gino at jakeandgino.com. If you want a copy of the book, signed copy, love to send one out for you. Jake, thanks for spending the day with me. All right, bro.
Love it. Thanks, Gino.